Welcome to today's deep dive. If you're looking at the equity markets, monitoring order book dynamics, and trying to parse whether the whole structural framework is just inherently biased against the average person, you are in the exact right place.
Yeah, absolutely. Today we are really focusing our lens on a layer of market microstructure that operates, entirely behind the scenes.
Right, at computational speeds that fundamentally alter how capital is allocated globally, we're dissecting high-frequency trading, or HFT.
It is a totally critical yet very opaque component of modern market plumbing.
And the mission for us today is to tear down that technical and regulatory architecture. We want to answer the questions you probably wondered about when looking at the stock market. Like, what exactly is HFT? Is the market actually rigged against you?
Right. Why is this even allowed and what do the actual experts say about it? We're looking at the realities of latency arbitrage, the empirical impact on everyday investors, and ultimately how global regulatory bodies are trying to manage an infrastructure they can barely monitor in real time.
To build this analysis, we're pulling from a pretty heavy stack of institutional sources today. We have an SEC concept release on equity market structure, cross-border regulatory analyses from the BIS, the Bank for International Settlements, and some really rigorous academic literature from NYU Stern covering flow toxicity.
And on the technical side, we are integrating industry infrastructure guidelines from places like Beta Broker and ByteMonk to understand the literal bare metal hardware making all this possible.
And as always, I have our resident expert here to help cut through the noise and synthesize all these complex concepts into clear, actionable insights for you.
Glad to dive in. I mean, we are looking at an intersection of high finance, theoretical physics, and network engineering. The implications here ripple out from institutional dark pools directly into the cost of capital for the broader real economy.
Okay, let's unpack this. When we talk about high-frequency trading, we need to completely delineate it from just standard algorithmic execution, right?
Right. It's not just fast trading. It's a highly specific subset. The SEC and the NYU Stern research outlined very specific parameters that categorize an HFT firm. We're looking at extraordinary turnover rates, but more importantly, and this is wild, staggering order-to-trade ratio.
The cancellation rates.
Exactly. The research notes that in many cases, HFT firms cancel upward of 98% of the orders they route to the matching engine before they ever execute.
Oh, wait, 98%, so they're just spamming the market and backing away.
Basically, yeah. That 98% cancellation rate completely upends traditional theories of market supply and demand. Those canceled orders aren't failed trades. They are a mechanism for price discovery. HFT algorithms are continuously pinging the market, submitting and withdrawing limit orders to map the liquidity landscape without actually committing capital.
That makes sense. They're feeling out the room.
Exactly. And another structural pillar of HFT is maintaining a flat position overnight. These firms are not taking directional bets on macroeconomic trends. They do not care if the S&P goes up or down over the next year.
They want zero market exposure when the closing bell rings.
Right. They start the day flat, process millions of microscopic transactions to capture fractional spreads, and they end the day flat. No overnight portfolios.
The concentration of market share here is what really shifts the paradigm for me. According to the NYU Stern data, HFT firms make up only about 2% of the trading entities in the U.S. equity markets.
2%.
2%. Yet they are responsible for over 70% of the total trading volume.
It's a massive consolidation of liquidity.
Over 70%. And the infrastructure required to maintain that volume is where we transition from financial strategy into pure physics, because you're dealing in microseconds and nanoseconds.
Oh, absolutely.
Yeah.
The industry metric you want to look at is the tick-to-trade pipeline. That's the total latency from receiving a market data packet to actually executing an order.
Yeah.
To compress that pipeline, firms use co-location.
Paying a massive premium to literally rack their servers in the exact same physical data center as the exchange's matching engine.
Right, like the Carteret facility in New Jersey for NASDAQ. You pay rent, essentially, to have shorter copper wires than the guy next to you.
What's fascinating here is how the nature of the competition has fundamentally migrated from who has the best trading algorithm to who has the fastest physical hardware.
Yeah, standard CPUs are essentially obsolete in this tier because they process instructions serially, one at a time.
Right.
HFT operations rely heavily on FPGA's field programmable gate arrays. These are integrated circuits designed to be configured by the customer after manufacturing. It allows firms to encode their trading algorithms directly onto the silicon itself.
So they're bypassing software entirely.
Exactly. It enables parallel processing at the hardware level, bypassing the operating system entirely to execute trades in nanoseconds. It's incredibly advanced engineering.
And the pursuit of those nanoseconds led to some incredible physical infrastructure projects. I mean, the classic example documented in Michael Lewis's book Flash Boys was the Spread Networks project. They spent something like $300 million to dig a perfectly straight trench through the Allegheny
Oh
Mountains,
yeah, just blasting through solid rock.
just to lay a fiber optic cable between the CME data center in Chicago and the equities exchanges in New Jersey. And all that capital expenditure was just to shave maybe 3 milliseconds off the round-trip latency.
And the crazy part, today, even that fiber line is considered slow. Firms now use specialized microwave networks.
Because signals traveling through the air move slightly faster than light refracting through the glass core of a fiber optic cable, it's just mind-blowing.
It is. The information read data from our sources actually quantifies this arms race.
Oh, wow.
They note that a mere 1 millisecond advantage can be worth upward of $100 million a year to a major brokerage firm in captured spreads.
100 million for a millisecond. Which naturally brings up the question that's probably on your mind right now. With all this tech, with all this money being spent on microwave towers, is the game rigged against the average person?
Right. Does this infrastructure create an inherently predatory environment? To answer that, we have to look really closely at latency arbitrage. It's essentially knowing the future, even if it's just fractions of a millisecond ahead of everyone else.
Because liquidity is highly fragmented across multiple electronic exchanges these days. The national best bid and offer, the NBBO, doesn't update across all those venues with perfect synchronicity.
Exactly. There's always a microsecond discrepancy between a leading exchange that processes a price movement first and a lagging exchange that is still broadcasting the old, stale quote.
Latency arbitrage exploits that lag, the delay in the securities information processor or the SIP feed.
Right. When an HFT algorithm detects a price shift on the fast feed, it simultaneously identifies those stale quotes resting on the slower exchanges. The algorithm can basically hit the bid on the lagging exchange at the lower stale price and instantly unload the position on the updated exchange at the higher price.
Locking in a risk-free arbitrage profit strictly predicated on transmission speed.
Yeah, and this is the exact mechanical inefficiency that prompted the creation of the IEX exchange.
Oh, right, the speed bump.
Exactly. IEX introduced a literal 38-mile spool of coiled fiber optic cable that every incoming order has to travel through. It's designed to delay all incoming orders by 350 microseconds, which effectively neutralizes the latency arbitrage's speed advantage.
And the data on how frequently this arbitrage occurs is pretty striking. We can look at the empirical findings from ASIC, that's the Australian securities regulator, specifically regarding dark pools.
Because dark pools lack pre-trade transparency and generally peg their execution prices to the public MBO, they are highly susceptible to this kind of latency arbitrage.
Right. ASIC found that HFTs are on the profitable side of trades referencing stale prices 85% of the time.
85%. Contrast that with regular non-HFT institutional users who only land on the winning side of those stale quote trades about 31 or 32% of the time.
So the structural speed advantage translates directly into sustained asymmetrical win rates.
It does. But we really need to distinguish between legal, albeit controversial, latency arbitrage, and outright illegal market manipulation.
Yeah.
The regulators draw a very sharp line here.
Right. The sources outline illegal tactics like, quote, stuffing. That's where an entity deliberately bottlenecks an exchange's matching engine by flooding it with millions of rapid-fire orders.
Just choking the system.
Exactly. Degrading the feed to artificially create the latency they need to arbitrage. And then there's spoofing, submitting massive fake limit orders to simulate artificial buy or sell pressure.
Inducing other market participants to react, and then instantly canceling the spoofed orders and trading against that momentum. Regulators actively pursue criminal charges for spoofing because it explicitly subverts price discovery.
Here's where it gets really interesting. Despite those well-documented costs of latency arbitrage and those manipulative edge cases, a substantial body of the academic literature actually argues the opposite.
Right. Playing devil's advocate using the NYU Stern research, the argument is that the net impact of HFT might actually be highly beneficial to overall market quality.
How so?
Well, by essentially automating the market-making function, HFTs provide continuous, incredibly dense liquidity. The hyper-competition among these quantitative firms has structurally narrowed the bid-ask spreads across virtually all liquid asset classes.
So when you, the retail investor, go to buy a stock on a standard app on your phone, the transaction is actually cheaper and faster today than it was 20 years ago.
Exactly. The cost savings you get from trading on a one-penny spread consistently outweigh the marginal risk of interacting with an HFT algorithm on the other side.
Because retail order flow is generally considered uninformed.
Uninformed, right. Meaning your purchase of 10 shares of Apple doesn't carry predictive weight regarding short-term price movements. So HFTs are perfectly willing to take the other side and collect that tiny spread.
But the dynamic shifts dramatically when we look at institutional order flow, the big players.
Right. That introduces the concept of flow toxicity,
Okay.
which is critical to understanding the institutional pain points here.
Yeah.
The NYU Stern paper uses the VPIN metric volume synchronized probability of informed trading to measure this.
Flow becomes toxic when market makers are systematically providing liquidity to informed traders, leading to adverse selection.
Yeah, think about a massive pension fund that needs to rebalance and buy a block of 1 million shares. Their order flow is highly informed and highly directional.
And they can't just buy 1 million shares all at once without spiking the price. So large institutional orders are typically sliced into smaller parent-child orders through algorithms over the course of hours or days.
And HFTs are incredibly adept at sniffing out those resting, sliced-up orders. Once an algorithm detects the footprint of a huge institutional buyer, they aggressively purchase the available liquidity ahead of the institution and then offer it back at a higher price.
Front running.
Exactly. It directly increases the implementation shortfall, the total cost of executing a large trade for the institutional investor. So while you, the retail trader, save a fraction of a cent on your app.
The pension fund managing your actual retirement account is bleeding basis points on massive capital allocations because they're getting picked off by algorithms.
If we connect this to the bigger picture, we have to look at the macroeconomic consequences outlined in the BIS Working Paper number 1290. The BIS evaluated this dual impact to determine how HFT changes the actual cost of capital for public companies in the real economy.
Right, because that's what markets are actually for at the end of the day, financing real businesses.
Exactly. And they discovered a bifurcated impact. For highly liquid, large-cap equities, the dense liquidity provided by HFT reduces the premium investors' demand, which marginally lowers the cost of capital for those big firms.
But the BIS paper notes a stark reversal for smaller, low-risk, low-beta equities. For those stocks, HFT actually raises financing costs.
Because HFT strategies rely so heavily on statistical arbitrage and index correlations, their algorithms often react uniformly to macroeconomic data.
So they amplify systematic risk.
Right. They force these otherwise stable, idiosyncratic stocks to move in lockstep with the broader market indices. They strip away their natural stability.
And the BIS concluded that, on an aggregate level, this risk-increasing channel is actually dominant. On balance, HFT raises the cost of capital on average across the broader market.
And that systemic correlation naturally leads to the major contradiction in the sources, the Dr. Jekyll and Mr. Hyde nature of HFT liquidity.
Right. HFT provides all this great liquidity when times are good and markets are calm. But what happens when markets panic?
The academic consensus describes it as flighty liquidity. You see, traditional designated market makers historically carried affirmative obligations.
Meaning they were mandated by the exchange to provide continuous two-sided quotes, right? To maintain an orderly market even when things got crazy.
Exactly. HFT firms have no such legal mandate. Their algorithms are strictly optimized for their own risk-adjusted returns. The millisecond that volatility hits, when that VPIN metric spikes and the order flow becomes overwhelmingly toxic, their risk parameters trigger an immediate withdrawal of all their resting limit orders.
They just vanish.
They unplug the machines, essentially.
And that sudden evaporation of the order book is the exact mechanism behind the flash crash of May 2010.
Oh, man. The joint SEC and CFTC report on that reconstructed the entire event down to the millisecond.
A mutual fund submitted a massive automated sell order, something like $4.1 billion worth of E-mini S&P 500 futures contracts.
Right, and their execution algorithm was just programmed to target a specific trading volume rate. Had no regard for price or time constraints. It just kept selling.
Initially, the HFT ecosystem absorbed the incoming sell pressure, acting like they normally do.
But because the institutional order was relentless, the HFTs quickly accumulated long positions that breached their internal risk capital thresholds. Their inventories filled up.
And once those thresholds were hit, the algorithms uniformly flipped. They went from acting as liquidity providers to aggressive liquidity takers. They began rapidly dumping their accumulated inventory into a market where the buy side of the order book had already completely vanished.
Aligning with the downward momentum. The algorithms were essentially trading the same contracts back and forth with each other, creating this terrifying, self-reinforcing feedback loop.
Nearly $1 trillion in market capitalization was wiped out in minutes, entirely divorced from any fundamental macroeconomic news.
And we saw the exact same structural failure during the January 2015 Swiss franc to peg.
Oh, yeah, when the Swiss National Bank unexpectedly removed its currency cap against the euro.
Extreme volatility spiked, and the HFTs immediately vanished entirely from the foreign exchange markets. They pulled all their quotes, leaving the traditional Tier 1 dealer banks trying to provide quotes in a complete vacuum, resulting in just massive, massive spreads.
So what does this all mean? How are regulators handling this double-edged sword?
It's a massive regulatory dilemma. The SEC and European authorities are in a really tough spot. If you implement draconian measures and completely ban HFT, the academic models dictate that bid-ask spreads will immediately widen back out.
Price discovery would degrade, and trading costs would spike for everyone, including retail investors.
Right. But a completely hands-off approach leaves the system totally vulnerable to these cascading flash crashes. This raises an important question. How do you establish guardrails on an ecosystem that operates at a latency below the threshold of human perception? How do you regulate a machine that thinks in nanoseconds?
The sources detail several distinct current regulatory solutions. In Europe, they implemented MiFID II.
All right. MiFID II requires authorized HFT firms to synchronize their trading clocks to within 1 microsecond of UTC-coordinated universal time using GPS precision.
And every single algorithmic trade must be tagged with a unique identifier, which doesn't necessarily prevent a flash crash.
No, it doesn't. But it guarantees that forensic analysts can recreate the exact sequence of events after the fact and pinpoint the specific algorithms that triggered the cascade.
Alternatively, you have jurisdictions using fiscal friction. Italy introduced a targeted HFT tax back in 2013, a 0.02% levy specifically on trades generated by algorithms where the order rests for less than half a second.
The goal there isn't really to generate tax revenue. It's a structural disincentive to curb those hyperactive, quote, cancellation rates and encourage longer-term liquidity.
And beyond taxes, there's intense debate around structural overhauls to kill the speed advantage entirely, specifically the idea of frequent batch auctions.
This is a fascinating proposal. Instead of matching orders continuously based on who gets there a microsecond faster, a frequent batch auction aggregates all buy and sell orders over a discrete time interval.
Say 1/10 of a second.
Right, and then it executes them all simultaneously at a single clearing price. It completely eliminates the value of a microsecond speed advantage.
So it neutralizes latency arbitrage and shifts the competition back to actually valuing the asset correctly, rather than just having the fastest fiber optic cable.
Exactly. It's an ongoing recalibration of market plumbing.
So to summarize our deep dive today, HFT is undeniably a marvel of modern quantitative engineering. It has permanently altered global finance, making trading cheaper and faster for the average investor by compressing those spreads.
But that efficiency comes with severe structural trade-offs. It enforces hidden costs on long-term institutional investors through adverse selection, relies on flighty liquidity that vanishes during panics, and introduces a structural fragility to the whole system.
It's not inherently rigged in the traditional sense, but it is an arms race where the fastest physics win and extract a consistent toll from slower participants.
That's a great way to put it. The current centralized equilibrium is incredibly fragile.
And looking forward, the paradigm is shifting yet again. I want to leave you with a final provocative thought drawn from the DeFi decentralized finance sources we reviewed.
This is where it gets really wild.
Right. Everything we've analyzed today, the SEC regulations, the circuit breakers, the centralized matching engines, relies on a central authority capable of halting trading when algorithms go rogue. But HFT is rapidly migrating into cryptocurrency and decentralized exchanges.
Using constant product market makers, or CPMMs like Uniswap.
Exactly. In this environment, latency arbitrage manifests as minor extractable value, or MEV. Ultrafast algorithms monitor the public mempool and execute complex sandwich attacks, front-running a retail order and instantly back-running it to extract the slippage.
But the profound difference here is the venue itself.
Right. These smart contracts are immutable. They operate globally on the blockchain, so imagine what happens next. What happens to market stability when hyperspeed quantitative strategies and algorithmic feedback loops execute latency arbitrage in an unstoppable, decentralized environment where there is no central regulator and absolutely no central authority to pull the plug?
It's a whole new frontier of risk.
It really is. Thank you for joining us for today's deep dive into the hidden architecture of the market. Keep analyzing the data, scrutinizing the systems you interact with, and questioning the mechanics operating just beneath the surface.